All right, let's dive in. Today, we're going to pull back the curtain on the invisible forces that pretty much run our economic world. We're talking about monetary policy. We'll explore these huge financial systems that are like the economy's central nervous system. And trust me, by the end of this, you'll see exactly how it all connects right back to your own wallet.
You ever stop and wonder who's actually turning the dials on the economy? I mean, who decides how much interest you're going to pay on your car loan? Or if the money you've saved is actually going to be worth anything next year? It's definitely not random. The answer is in a powerful, deliberate system that we are about to unpack.
So why should you care about any of this? Well, because these aren't just some abstract ideas for economists to debate. Nope. These systems are basically the guardians of our collective economic health, and they influence everything from whether you have a job to how much a gallon of milk costs.
Look, think of a stable financial system as the bedrock of a healthy economy. It's kind of like the plumbing in a city. You don't really think about it when it's working, but it lets money and credit flow where they need to go. It helps businesses grow, create jobs, and it lets all of us plan for the future with some confidence. When the plumbing is working, the whole city, the whole economy thrives.
Okay, so who's the chief engineer of this whole system? That brings us to the star of our show, the central bank. Let's pop open its toolkit and see exactly how it keeps the economic engine humming. Pretty much every country has one. A central bank is the public authority that's in charge of a nation's money. Now, its job isn't to make a profit for shareholders. Its job is to serve the public by keeping the whole financial system stable and the economy on a steady course. So what is that steady course? Well, their mission really boils down to three huge things. First, keep prices stable by taming inflation. That's absolutely crucial for protecting the value of your money. Second, create the conditions for the economy to grow and create jobs. And third, and this is a big one, act as the ultimate backstop to prevent the entire financial system from collapsing. It's a massive, massive responsibility. So how do they actually do all this? Well, they've got this really powerful toolkit. It's kind of like they're controlling a thermostat for the economy. They can raise or lower interest rates to make borrowing cheaper or more expensive. They use something called open market operations to add or remove money from the system. They set the rules for how much cash banks need to keep on hand. And, so importantly, they communicate their plans to guide what everyone expects to happen next.
And this is where it gets really interesting. A single decision, like tweaking that main interest rate, creates this massive ripple effect. It's like dropping a pebble in a pond. It travels through your mortgage rate, it affects how willing banks are to lend money, it can even change the value of the currency, and it shapes what we all think is going to happen in the future. All of that is how they steer inflation and jobs. Okay, so having all these tools is great, but it's not the whole story. Not even close. For this whole system to actually work, it has to be built on a solid foundation of trust, smart rules, and a really clear-eyed understanding of risk. Let's see what that looks like.
This really gets to the heart of it. A central bank's most powerful asset isn't interest rates or printing money. It's credibility. It's trust. If people and businesses believe that the central bank will do what it says it's going to do, like keep inflation under control, then that belief itself becomes an incredibly powerful tool. In this game, trust is everything.
So, how do you build that kind of trust? Well, it's this amazing cycle you see here. It all starts with independence, making sure the central bank can make tough calls without politicians breathing down its neck. That independence is what builds credibility. But, and this is key, to be legitimate, that power has to be balanced with accountability to the public. It's a really delicate but absolutely essential balancing act.
Now, let's talk about the 2008 financial crisis. The huge, painful lesson from that whole mess was that making sure individual banks were healthy simply wasn't enough. Regulators suddenly realized they had been focusing on the trees while completely missing the fact that the entire forest was about to catch fire.
This totally new way of thinking is called macro-prudential policy. And I'm not exaggerating when I say this shift was a game changer. Think of it this way. Instead of just inspecting individual cars for safety, regulators started designing safer highways for everybody, building guardrails and setting system-wide speed limits to prevent those massive catastrophic pileups.
So what do these safer highway rules actually look like? Well, to cool down a credit boom, they can force banks to build up extra capital like a rainy day fund during the good times. To stop a housing bubble from getting out of control, they can put limits on how much people can borrow. Each tool is designed to target a specific risk to the whole system.
That, of course, sometimes, despite all the safeguards, despite all the best intentions, the system does break. So let's take a look at what happens when things go really wrong and a financial crisis hits. Here's the most important thing to get. Financial crises are not like lightning strikes from a clear blue sky. They're not random acts of nature. They are almost always the predictable result of vulnerabilities, things like too much debt or weak regulations that have been building up under the surface for years. They are systemic failures.
So, what does a crisis actually feel like? It's a sudden, violent disruption. Confidence just vanishes overnight, funding dries up, asset prices collapse, and the flow of credit that the real economy needs to survive just freezes. The damage can be absolutely devastating and last for a very long time.
The engine that drives these crises is something called systemic risk. Our financial system is so incredibly interconnected now that the failure of just one company can trigger a horrifying domino effect, bringing the whole structure crashing down. That is the nightmare scenario that keeps regulators up at night.
All right, for our last section, let's shift gears and look to the future. Because technology isn't just changing how we buy things, it is fundamentally changing what money is.
Right now, it feels like we're at a fork in the road. On one side, you have private, decentralized digital currencies, like Bitcoin. On the other, you have this idea that central banks themselves are looking into, central bank digital currencies, or CBDCs. The difference is huge: who issues it and who controls it. One could weaken a central bank's grip on the economy, while the other could actually make it stronger.
And this right here is the massive dilemma facing policymakers everywhere. On the one hand, the promise is incredible. Faster, cheaper payments, bringing more people into the financial system. But the peril is just as big. Huge cybersecurity threats, massive questions about our data privacy, and completely new kinds of financial risk we're only just beginning to understand.
So, just to be super clear, a CBDC would basically be the digital version of the cash in your wallet. It would be an official digital dollar or a digital euro, issued and backed by the central bank, just like paper money is today.
And all of this brings us to one final critical question. As money transforms from paper and metal into pure programmable code, what does that future look like? What will it mean for your privacy, for the security of your wealth, and for the balance of power between all of us and the state? That is the conversation we all need to start having right now.